My name is Francisco Guzman. I am a director of Chile Day, and I'm here to continue presenting the agenda for this first day of Chile Day New York. Our next panel is regarding investment trends in alternative assets. As you may be aware, alternative assets play a key role, especially in times of global uncertainty. So now is a very interesting moment to have this discussion. And the idea is to debate regarding how the local and international investors are adapting their strategies and portfolios to include alternative investments. So let's welcome Vic Shoney, Chief Administrative Officer of Blackstone, Scott Hart, CEO of Stepstone Group, Diego Sekonsky from AFP Plan Vital, Patricio Muñoz, CIO of AFP Provida, and Axel Christensen, Director of Investment Strategy for Latin America of BlackRock, who will participate as moderator. So let's welcome this panel and panelists.
Thank you, Francisco. Can you hear me well? Yeah. Okay. So we're going to shift a little bit gears here and going to talk about the other side. We talked a lot about projects and permitting. We're going to talk about the money that makes those projects come true. Talk about very important players here. So let me just tell you how excited I am to be part of today's event. I'm luckily enough was part of the first Chile Day in 2009 that happened here in New York as well. It was only half a day back then, and we had a very interesting event happened that day that our keynote speaker, who was Dr. Nuno Rubini, Dr. Doom for many investors, he called a bottom to the US stock market in our event. So hopefully we get that type of impact on markets. Let me introduce our speakers today. And before that, just mention how important alternative investments are. They are central in providing funding to some of the very large-scale projects that we just mentioned. They make available capital to companies to develop innovation. So very important parts of the financial ecosystem. And then the timing couldn't be better. In the case of Chile, we're going through some very significant changes related to perhaps the most important institutional investors. And we have a representative of a couple of them here today as well. There's a pension reform that is being implemented that will have alternatives as a very key component to that. The format of today's panel is very straightforward. I'm going to let each one of you provide some introductory comments. Then we'll get to some questions. And then, if we have time, open the questions to the audience as well. But as I mentioned, let me briefly introduce who are our panelists today. Let me start by Vic. Vic Sahani is Blackstone's Chief Administrative Officer. He's also the Global Head of the Institutional Client Solutions Team and a member of the firm's Management Committee. Vic oversees relationships with the largest investors worldwide and drives strategic initiatives across asset classes. Scott Hart is the CEO of Stepstone Group, where he also leads their global private equity platform and serves on the board of the firm's board of directors. Stepstone and Scott have been pivotal in growing the global presence and tailoring private market access for institutional clients. We have then Diego Sekonsky. He's the Chief Investment Officer at AFP Plan Vital in Chile. Diego has spearheaded investment strategy and has been at the forefront of the efforts to incorporate alternatives in the Chilean pension landscape. And then finally, to my right is Patricio Muñoz. He's also Chief Investment Officer at Provida AFP, also a pension fund management company in Chile. He brings deep experience in the asset allocation process and developing global investment strategy. So, to start off, I'd like to invite each one of you to share some brief opening remarks, about 2 minutes each. Vic, why don't we start with you?
Great. Well, first, thank you very much for having me here. It's an honor to be here. I'm a little embarrassed because I asked if I should wear a tie, and they said, no, everybody's very casual. Nobody's going to be wearing a tie. So here I am, and I'm a little bit embarrassed about that. Second, I normally travel to Chile in the summer, and I usually take the red-eye down, spend the whole day, get back on the plane, and fly back. And so this is much better to walk from 51st Street to 45th Street. So I'm grateful for that. As well. But, in all seriousness, I would say a few things. We've been doing business in Chile and in South America with our partners at Compass Group for a long time. And in some ways, in many ways actually, your pension system is more sophisticated than the systems in other parts of the world. And the private management of pension assets I think is something to be sort of praised and lauded. And as we follow all of the reforms that are happening in the ebbs and flows, I hope that all of the good work that's been done and a lot of the innovation that's been done by the AFPs over the years will be allowed to continue. Because it's really, as somebody who travels, and Scott does as well, all around the world, and just looking at our own systems here in the US, you have very, very sophisticated systems and sophisticated people. And so we admire those. In terms of, I'm probably close to out of my 2 minutes, I think some of the things we'll talk about today is sort of evolution of what's happening in alternatives. And I think there are a few things happening. One is people traditionally looked at alternatives as investing in private equity funds, buyouts. And that aperture has gotten much wider to include things like private credit, infrastructure, secondaries, so wider array of products. The second thing that people are really thinking about is what's the structure of the way they invest their capital? Is it in a closed-end drawdown fund where you put your money in and it gets drawn down over time and you get it back? Or is it in some different sort of a vehicle, a perpetual capital vehicle, which has different liquidity? Maybe you're buying into an established portfolio. And so flexibility about what investors need in terms of return, duration, liquidity. I think there are more choices, and everybody is thinking about how to attack those choices. And then sort of the third thing I would mention, which is a little bit like the first, is just thinking about investment-grade credit, which has traditionally been a liquid asset class, and the ability to earn higher returns, taking lower risk by taking some illiquidity. So I think those are some of the
Great.
topics maybe
Thank
we
you,
can
Vic.
touch on.
How about you, Scott?
Yeah, well, I'd echo some of Vic's comments there. First of all, thanks for having me. First time attending Chile Days, so great to be here. It has been an important market for us here at StepStone as well. Pleased to have my colleague Andrea in the audience from our Chile office. But one of the things that we were asked to sort of kick off with is, what's the one major trend driving the private markets or the alternative asset industry today? And there's obviously a number of different directions that we could go. Look forward to diving into some of the topics that Vic just mentioned. But the one that stands out to me is, look, there are both a number of challenges as well as opportunities in the market today. And I have found myself in all of the meetings I've been doing over the last few months, same set of statistics seems to come up in every conversation, which is if you look back at how the private markets have evolved over the last 20 years, if I sort of rewind the clock to when StepStone was founded in 2007, there was something like $1 trillion of dry powder in the market available to be invested in private equity in the private markets. There was also about $1 trillion of unrealized net asset value, basically companies that were in the ground invested in by private markets firms. When you fast forward the clock, it's interesting. The question that we get at StepStone more often than not is, how are we going to deal with all the dry powder that exists in the market? But if you actually look at how the industry has evolved, that $1 trillion of dry powder has gone to something like $2.5 trillion of dry powder. It's actually the unrealized net asset value of companies and assets in the ground that's gone from $1 trillion to $8.5 trillion during that time period. And so I think the bigger question for us to be focused on is how are we going to exit that $8.5 trillion backlog of companies? And the reason I mention that as sort of an important trend is I think there are a number of related points to that, whether it is what has driven the growth in that unrealized net asset value is realizations have been down dramatically over the last 3 years. The lack of realizations is driving more and more innovation in the industry, not just what Vic mentioned, but also new ways to generate liquidity for investors, whether continuation vehicles, NAV loans, et cetera. I think it's putting some pressure on returns as hold periods extend. So today, 50% of unrealized companies are north of 5 years old in a private equity portfolio, a mature private equity portfolio. We've never seen that length of hold period before. But it's also creating opportunities. And when I look at that again, backlog of unrealized companies, that spells a massive secondaries opportunity in my mind. You think about the secondaries market that's developed over time, had a record year last year with $160 billion of volume. That's a drop in the bucket compared to the $8.5 trillion. So my point is, I think there are both challenges that the industry faces, but also great opportunity that lies ahead of us today.
Thanks, Scott. How about Diego? What do you think about all this?
Yeah, well, thank you for having me. In name of the AFP Plan Vidal, we are very honored to be here. Well, alternative assets have been a very important component of our portfolios as a whole. Things that you bring, new way of investment, liquidity are issues that we are very concerned about it, but also we see the opportunities in there. So for us, it's not a question of alternative asset or not. It's more about the next regulation that is coming, that if it allowed us to implement more in that way. So we are more concerned about that than the alternative asset as a whole, because we know that is the next steps in the investment world, like high yield, fixed income high yield in the past was kind of an issue, or more risky assets. Alternative assets today is kind of the new way, no? So this is our main concern about the new regime is coming.
Right. And Patricio, how about you bring us?
Yeah. Well, first of all, thank you for the invitation. For me, it's a pleasure to be here. And well, my first thoughts are kind of the same as Scott and Diego. So the first one, like the big trend that is tailoring the investment in alternative assets right now is the lack of liquidity. So with the recent raise that we have seen in interest rates, so the exit activities are more difficult, and so we see the IPOs are scarce, M&As has slowed. So we see a trend that is getting more difficult as an investor in order to invest in these alternative assets. But anyway, even though these put pressures, we'll see in GPs more secondary funds, more continuation funds. We see more semi-liquid structures, and we see more focus into value creation more than in let's say, financial engineering for the portfolio. So, and for us, for the LPs, it's tough because the selection of instruments, it's getting difficult. The dispersion in returns has increased. So we need to identify the GPs, the managers that still are able to raise capital and to avoid the ones that are struggling. And that's from the sense of an investor looking the trends in the assets. But when we look inside in our country, as Diego says, like we have a huge challenge, that is the implementation of the reform, that I think we are going to talk in more detail during this panel.
Of course we are. So we'll get a bit more into details, but if it's okay with you, let's start with some moderatory questions. I've sent you some questions for you to prepare. Vic, Blackstone is often seen both as a bellwether and a driver of flows in the alternative space. We heard from Patricio some of the challenges in the category, in the asset class. From your conversations with likewise institutional clients that you might have globally, what are some of the emerging trends that you're seeing developing, rolling out for the next, say, 3 to 5 years? And you mentioned kind of the different buckets. You talked about private equity, but also credit, infrastructure, maybe real estate is having somewhat of a comeback as well. Can you tell us a little bit from your unique perspective how you're seeing the developments in the industry?
Sure, and I touched on a little bit before, so I'll try not to be repetitive. I think to start with real estate, since you mentioned it, it's still a little bit of a four-letter word, right? Because people tend to look backwards, not forward. And they see, because we've had higher interest rates and higher cap rates, performance of real estate portfolios has been a little bit more challenging. And generally, when nobody wants to invest in something, it is a very good time to invest in something. And so if you look at what's happening in the US and the world, is construction has plummeted in each of the major areas of commercial real estate. And if you look at just here in the United States, we're building the same number of new dwellings today in 2025 as we were in 1965. So that was so long ago, even I wasn't alive. And the population of the country has doubled. So I think, real estate has been through a tougher cyclical period. At Blackstone, just as a point of interest, we bought our first U.S. office building in a decade because we were buying it at such a steep discount to physical replacement cost that, you could make the math work and it was well occupied. So a big discount to physical replacement cost. High occupancy demand at good rental rates. So I think real estate is something that's been out of favor, but will cyclically recover as it tends to do. Infrastructure, I think, is a really interesting asset class for everybody because it's sort of a funny thing where every major economy in the world requires more infrastructure, whether it's digital infrastructure, energy-related infrastructure, or transportation-related infrastructure. And there's not that much capital. So this is very interesting. If we could sit here and name good private equity firms, we'd be here all day, right? There are hundreds, thousands. Infrastructure, it would take us 3 minutes. So that's very funny. The demand for capital greatly exceeds the supply of capital, and that's a place where we're seeing more investors where they say, well, the world's a little bit weird, uncertain. I'd rather invest in something where the revenues are either contracted or regulated, and there's some bit of a yield, and there's some asset coverage. So I think allocation to infrastructure is growing, and is going to grow very substantially. And then I'll stop talking and cede the floor because I talked about a bunch of this before. I think this question for investors about duration versus liquidity versus return and the pros and cons of those two things and the benefits of compounding relative to return. People are thinking about those things in new ways, and it's changing the way that they allocate capital. The other thing that's happened, which I don't know how much of it is cyclical versus secular, is the demand for customization on the part of asset owners, capital allocators. And I worry about that sometimes because when you over-customize things and then the way you want to do business changes and you're not so happy you did that. But that is definitely a very prevalent trend, is more customization. A little bit of it's cyclical when the allocator has more negotiating leverage than the GP, they can try to customize more. But that I would say that's very, very prevalent. And the last one, co-investment, again, cyclical, structural, and what I worry about there is, everybody wants to do co-investment because it's free. Everybody likes free things. But you can end up with excess concentration in individual assets, and you're moving away from sort of the cardinal rule of diversification. And if it works, it's great. And if it doesn't work, it's terrible. And so you just have to be careful about maintaining diversification.
Great. So, well, Scott, StepStone works across a vast platform with LPs around the world. Can you tell us what are the biggest shifts you're seeing on how, clients like some pension funds in Chile might be thinking of their structure to their commitments and alternatives?
Yeah, no, absolutely. I mean, I think in some ways, like Blackstone, a very global firm here at StepStone, have the privilege of working with clients around the world. And I think part of our success over the years has been spending time listening to and understanding what's on the mind of our clients so we can figure out how to best address some of the challenges they might face. So, just even in the last couple of months, I've had the opportunity to travel out around Asia, Middle East, Europe. We have hosted client events back in April in Chile, in London, in Zurich. And so really feel like we've got a good pulse on what's going on with our clients. So a few observations I would share. One, there are very few clients that we talk to and interact with that are thinking about reducing their allocations to alternatives or the private markets. Now, there may be more room for growth in certain of those asset classes like infrastructure and private credit, as Vic just mentioned, either because they're growing from a small base or because the definition of what's included in private infrastructure or private credit is expanding the size of the asset class. So certainly room for growth in those areas. But even in areas like private equity and real estate, we see very few of our clients thinking about reducing their allocation. If anything, they are stable or growing. They may find themselves in a situation where they are temporarily over-allocated relative to where they want to be. But again, very good long-term support for the asset classes. The second observation I would make is that the asset owners and LPs we interact with today, they want more for their money than just returns. The returns are table stakes, but whether it is co-investment opportunities, whether it is customization, whether it is wanting their partners to open offices locally, either to better service them as a client or invest in their local markets, whether it's an increase in training and providing data and knowledge transfer to their employees, there are a number of situations where I think LPs and asset owners are looking for a partner. The old way of just raising a fund, checking in once a year at the annual meeting, and then coming back when it's time to raise the next fund, I think is sort of an outdated way of interacting with our clients. And then the last point I would make, there are pretty significant differences by geography, but you also can pick up on certain trends. And so whether it's if you spend a few days in Australia, you'll very quickly understand there's great support for private markets, but there's incredible fee sensitivity. So how can we figure out the most fee-efficient way to invest in the asset class? You spend time in the Middle East, you realize that in addition to some of the longest-standing investors in alternatives, there are new pools of capital coming online each month with big plans for investing in alternatives. And obviously in the U.S. even, we've seen a bit of changing of the guard, where obviously the endowments today are under a bit of pressure. Public pension funds probably have a bit more mature portfolio. So a lot of the talk is about private wealth and about retirement accounts as new areas for growth. So those are a few of, I'd say, the observations that we've got from interacting with our clients in recent months.
Great. Thanks so much. Patricio, why don't we kind of focus on how, as an investor, you have seen the evolution of alternatives within your asset allocation process. You've been, as you mentioned, you're facing challenges, but you've been also kind of growing with the asset class and seeing how it works to at the end of the day, improve the pensions that you're paying to your clients.
Sure. So that's a great question, because now, as we said, we are facing challenges that we need to come up with a supportive legislation in order to invest in alternatives. And I want to briefly summarize the path that we have gone through all these years, and to try to not to go back in this path.
Of course.
So it's very important. Let's say that the allocation in alternative investments in our funds has been increased a lot, I would say in both scope and complexity. And this is because we found in alternative investments diversification and also returns. But moreover, it's a very good way in order to differentiate our portfolios. So we know that AFPs always try to differentiate, so alternative it's a really good way. So a little bit of the past, very, very, very short, would be like we started in 1990s in Chile, investing in real estate and infrastructure. Then in early 2000s, we start investing in international private equities, secondaries, leverage buyouts. But then we struggled to continue investing because we didn't have a supporting legislation. So at that moment, we need to invest through local feeder funds, and also all alternative assets were classified as equities. So that's a huge problem for fixed income. But a tipping point, I would say, come in the reform of 2017, where we were allowed to invest directly in alternative assets. So we were able to become a LP in commingled funds, and also co-invest alongside with GPs. And also a bucket for fixed income was developed. So now we can invest in private credit. Sorry, we can invest in real estate and infrastructure. So the portfolio really got a jump, and now we can, diversify by manager, by vintage, by strategy, by asset class, and the same with fixed income. So then we can invest in all the other asset classes. So we start investing in private lending, in mezzanines, and things like that. So the complexity keeps going, and then after this reform, we start investing in co-investments, and also you could find more complex structures such as SMAs. And this is because, again, we found a lot of profits there and also diversification. And our regulator, the Superintendencia, has also demonstrated that. They have their own analysis, and they have shown that, like, the average alternatives portfolio outperforms the average performance of the APs. So that's why we think we have to continue going in this path. Other thing is that, talking about the complexity that we have and how we have evolved our investments, is that right now around 60% of our investments are made directly. So we are poised to continue investing in alternatives. To have a targeted fund, it's an issue. It's difficult to incorporate this asset class in this kind of funds, but we really want to do that, and we are working in order to get supportive legislation to continue this path that we, again, don't want to go back.
Great. Diego, so Patricio just mentioned about wanting to continue and this shift into generational fund structures in Chile. Can you tell us a little bit your thoughts on what role will alternatives have in that new type of design?
Oh, yes. I think alternative asset is the perfect match for generational funds, because you can provide, you have a lot of type of asset class in the world of alternative asset that can bring you that match the life of each fund that we need to provide to our clients. So for us, it's more a concern of how much alternative asset has to be in the portfolio to provide that extra alpha that we need to achieve. These rules we don't know yet. I hope soon, and then we can create this portfolio and try to optimize to the better outcome in terms of returns. And also, of course, that alternative assets are this correlation with the regular assets. So for us, in this type of environment, when regulation and geopolitical stuff is happening in the world, alternative assets provide us kind of a cushion of some returns in this shaky path and volatility. So again, I think our concern is not about alternative assets; it's about how much it will be in the portfolios, and I hope they will be as many papers that we bring in the past, in the Chile Day Pass, or when other conversation with the regulator about being the benchmark of other pensioners or pension funds that provide more investment in this type of assets. Yeah.
Hey, as a follow-up, Diego, can you go into some of the challenges that the reform you think is bringing? There's some very specific designs, not only these life cycle generational funds, but also the fact that there will be some movement of contributors from one to the other every 2 years. You have some performance incentives around a benchmark. So how does that challenge your aspirations around alternatives?
Yeah, there's two part of that. The first one is demographics of each pension fund. It's very important to realize which are the demographics, so then you can start building your portfolio asset class and your glide path in that terms. Of course, there is a lot of challenge because you have to start splitting contracts, talking with you guys to realize the best way to do it. And of course, operationally, it could be a mess, but I think we'll manage that. You know? But after this first punch or first startup of making these portfolios, comes the second wave of dealing with this auction of the 10% of the assets. For us, I think it's not a good idea because we'll in some way change our trajectory in terms of the glide path what we already built. So we need the flexibility of making changes in your path to kind of realign the trajectory, you know. And the other problem is that you know that all the AFP has their own alternative asset politics, so it's kind of very different from one of others. So for us, or for one of them, could be a very restrictive in terms of which assets or which alternative assets they allowed in the portfolio. So if you receive one of these in yours, it could be a kind of a problem because it will be against your internal politics, you know. So we need to kind of find kind of a common law in terms of alternative asset through the AFPs to be able to not have this type of problem. If not, we wanted to have, it will be a mess to go every time to the superintendencia to tell this type of problems, and I think they can manage that, and we can have the amount of time and resources to deal with it. So
Yeah. So, Patricio, Diego mentioned several challenges.
Yeah.
Have you thought about any ways of kind of, you know, addressing those challenges, perhaps some solutions that you might want to share with us?
Yes, thank you. So first I want to add another challenge that what Diego was mentioned, but it's about the benchmark. So we have in our hands, basically the superintendencia has in their hands, you know, the benchmark creation, and we believe that this should be like designed with big asset classes. Like we need to try to avoid, you know, a lot of aggregation or have a benchmark defined in subclasses, because otherwise, if we do that in that way, it will prevent for us to invest freely and to differentiate among ourselves. I think that's very important. And the great news is that in hands of the superintendencia, and they can do it. The other thing, talking about the challenges that you have said, basically it's, for example, when you receive something that it's not, or it's contrary to your investment policy, that's a problem, but I would say that could be easy solved. You can have like a veto power for the AFP that is winning this action process, or maybe that should not be, you know, aleatory, so it should be like against your policy that is already agreed and things like that. You can classify some alternative assets as non-transferable, things like that. But I would focus more than that, saying that this auction process is also bad because it does not give us incentives in order to improve our alternative program. Why? Because if I have to invest a lot of money, you know, in the diligence processes to try to make a very complex, you know, portfolio that will differentiate me, then I will have to pass all my job in 2 more years. So I don't like that. So that creates a problem that the complexity of our portfolios will decrease. But I would like to propose like a change that it's a small trick that we can do, and that may improve a lot this tender process. Even like we don't like it, but if we want to continue with this process, which is not in our hands, what we can do is like, so all the discussion of this process had in mind that we compete in fees and performance. But it's not the case. We also compete, and it's very important, maybe the most important thing here is the quality of service, right? And this is like usually overlooked dimension in the businesses, but they are key to have like a great user experience, and the end has a lot to do in the perception of our affiliates in how the system works, right? So what we have right now, it's like an opt-out process in which like the affiliates are moved from aleatory from one fund to the other, and then they can opt out. They have like a, I don't know, 15 days window, but we should change this and put like a customer center tender process and to move in an opt-in. What does it mean? That the affiliate has to actively declare, oh, I want to move because I'm not happy with my AFP. Because that includes performance, includes services, includes fees, right? With that, we believe that the amount of people and the AUMs that move from one AFP to another one will be diminished, and these problems will be solved. And I think it has three good characteristics, is that we respect, the autonomy of our clients. Second, we put more emphasis in the quality of service, which is very important. And the third one, we can avoid some questions or some problems with the clients that they value stability and they can value like the long-term relationship that they have with the AFP.
Yeah, that's very interesting. Scott, so we just heard from Diego, from Patricio, a lot of specific needs on providers, perhaps like StepStone. How do you see, the process of perhaps bringing all your experience you mentioned about Australia, perhaps what's going on here in the U.S. Is there any chance that pension funds in Chile can kind of accelerate or leapfrog in their development rather than going kind of this very windy road that alternatives have seen in pension funds here in the U.S., for instance?
Yeah, no, absolutely. I think there are a number of opportunities to accelerate the learning curve, to learn from the good and bad decisions that others might have made in the past. There's also a number of challenges with starting newer alternatives programs today. As Vic mentioned, we could probably name hundreds, if not thousands, of very good private equity managers. Unfortunately, you can probably name hundreds or thousands of not so good ones as well. So there's a lot to choose from. The asset class has become more complex. It's not just about private equity anymore. We talked about private credit, real estate, infrastructure, and within any of those asset classes, there are strategies and sub-strategies that have made the overall ecosystem much more complex. The good news is, to accelerate that learning curve, there is a lot more information available. I'm going to give you a little bit of a sense for how far the industry has come. When I took my first private equity job at TPG 20 years ago and was interviewing for that job, they didn't even have a website. I mean, it was impossible to learn anything about the firm heading into that interview. To give sort of another example, if I compare the experience we had going through the financial crisis to the experience during COVID in terms of the amount of data and information and communication that was available from our GPs, it was night and day. I mean, during the financial crisis, quarterly reports, you didn't have the underlying financial performance of the companies. You didn't have the valuation methodology. It was pulling teeth to get some of that information. Compare that to COVID or more recently the trade war here. The amount of communication and how much transparency there is with our GPs has changed dramatically. And I think there are a number of groups out there providing incredible training and education about the asset class. You go to Blackstone's website and look at Blackstone University. I mean, the amount of information that is now out there. You go to StepStone's website, look at some of the white papers and the training materials, or the fact that we and others are willing to host our clients for secondment programs or training programs to help them accelerate up the curve, even if the ultimate goal is to be doing some of what we are currently helping them with directly themselves. And that was sort of the internal debate that we often had about offering this type of training. Well, isn't the client just trying to replicate what we're helping them do? And I said, maybe they are, maybe they aren't. Whether we help them with that journey or not, that may be where they're trying to get to. And I think if anything, that level of interaction with our clients has just led to a much closer, a much more powerful relationship. But there's a number of different ways to, I think, accelerate that learning curve given all the information, education, et cetera, that's out there today.
Very interesting. Vic, I want to bring you to one dimension that Diego and Patricio kind of mentioned. Some of the challenges would require providing liquidity into the alternatives asset class. And Blackstone has been, developing access, including, bridging that kind of perceived disconnection between illiquid assets and how can we provide some liquidity windows or features. Can you tell us a little bit how you see that evolving, and is there kind of any space for either pension funds requiring this type of liquidity because they have shifts between their contributors, or in the wealth space nowadays that there's a high demand for the type of returns or diversification alternatives they're providing?
Yeah, so, what you're referring to is sort of what people are calling semi-liquid perpetual capital vehicles, where you set things up where they keep a certain amount of the invested capital in liquid assets, leveraged loans, or whatever it might be. And they have parameters under which there might be a cap on redemption dollars that's quarterly or semi-annually or something like that. But the vehicles are set up in a way that you do have this liquidity valve. And what we've found, there were some pretty tough cyclical periods actually, is that these things actually work. Because what you don't want is for a manager that owns illiquid assets to be forced to sell them, right? Like a cardinal sin in investing is duration mismatch, right? That's a mistake you just can't make. So you can't own illiquid assets and have liabilities which can disappear in a minute, which is what banks are, right? Where you can pull up your phone, you can take all your money out in 3 seconds, and that those are their liabilities. Their assets are not that liquid. So these structures, I think, are quite robust, quite resilient, and they won't always be perfect in times where everybody wants liquidity, but if you have a little bit of patience, they tend to work quite well. And the trade-off for investors is, does that lead to a little bit of a lower IRR because you have to keep some liquid assets on hand? Probably does. Yeah. But you're compounding those assets rather than dealing with a J curve. So I think one thing that I've been struck by in our business is our individual investors have not figured out, but are more focused on the math of compounding than our institutional investors, right? If you compound something at 10% for 5 years, you have more than 1.5 times your money. And if you invest in a drawdown fund, in 5 years, you don't have 1.5 times your money because the money is being drawn down over 3 or 4 years. So I do think these semi-liquid structures, which are evolving, growing, will have more appeal to institutions and to individuals. And for retirement assets, I don't know exactly how it works. It sounds like a little bit more proactive in Chile, but in the US, with a 401k, you sort of make a decision when you're very young, and you never look at it again until you're very old. And so this is the ultimate, compounding is your greatest friend, right? And so retirement assets are particularly well suited to these sort of semi-liquid products as part of I think what you call a generational fund.
Right,
or
life cycle as they call it.
Yeah, we would call it, I think it's like a target date fund.
Yeah. Exactly.
Yeah.
Well, thank you, Vic. And let me end this round of questions with one question I want to ask you, very brief answers. Let's say we are, celebrating Chile Day 2030, 5 years from now. What do you think would be the major changes that you would have not been able to see necessarily in the industry or alternatives 5 years from now? What would surprise you happening 5 years from now? I'll start with you back, Vic.
Okay, so we want it to be a surprise. So it can't be any more alternatives. We're not going to say any of that.
No.
Surprise. All of this private equity stuff that Scott was talking about, that everybody was talking about, unrealized assets, this is going to work out better than everybody thinks. So that's my surprise. I'm an optimistic person. Okay. It will turn out better.
All right, we'll see if that matches Rubini's call on the bottom of the market in 2009.
There you go. I'm calling
there
it.
You go. There you go. How about you, Scott?
That's good. I mean, the surprise part is the hard part, right? Because I think you're inclined to say something about the role that AI is going to be playing in our investment process, et cetera, or just the growth in private wealth assets. But maybe it's that. I mean, look, and a bit contrary to where I kind of started talking about, well, how are we going to get all this liquidity? Maybe it's that investors just become much more comfortable with almost the Berkshire Hathaway approach of long-term, hold and not having to sell. And whether it's through the evergreen type vehicles or sort of borrowing a little bit from one of our, more forward-thinking clients who a few years ago, as they were launching their private markets program, saying, look, I want to tear up the old way of doing things and just committing to drawdown funds, et cetera. We've got a very long-term liability profile. I may want to own some of these great assets forever. And so I wonder if we don't see a bit more of that out of the institutions that we work with.
Yeah, what would be your surprise 5 years from now?
Well, I think we will talking about that part of the best result that we have in the AFPs will come from alternative assets. I think the alpha will come from there more than regular asset class that we already own. But for me, the surprise will be that I think we'll have a democratization on the alternative assets in the retail world. So I think this is a trend that in some point we will see that everybody, you don't need to have to in the pension fund or in a specific vehicle to be able to grasp this type of assets, but a person with a cell phone will be able to buy this type of assets that are very good in delivering returns in the long term.
So bring it home, Patricio.
Yeah. Yeah,
Surprise,
so for
surprise.
me, the best surprise would be that no more surprises. Like
Okay, I like that one.
that was, I would say,
Yeah.
the best one.
Well
So because we, as a long-term investors, we like that, predictability, stability. That's the way that we can create alternative programs. We have no problems, and also that's it's like a smooth transitions into targeted funds, supported regulations for our alternative program, and also a well-defined benchmark that allowed us to differentiate ourselves.
Yes.
So no surprises. That would be great.
I remember a campaign here for hotels a long time ago saying that the best surprise is no surprise.
Yeah.
I think definitely I take on that. So I know we're running on time, so I really want to thank all you guys for your insights. Very interesting. I learned a lot of things, in terms of, how, for instance, Vic, customization kind of cuts both ways. You want to be careful in terms of how specific, because, there might be some unpleasant surprises. Some of the acceleration, opportunities that you mentioned, Scott, I think are very interesting in terms of seeing how, pension funds like Chile can take advantage of what information is available now. How can you get a better sense of how you're deploying your capital in the alternative space? And Diego and Patricio, I think you mentioned well how alternatives have been a very important component of building better portfolios, better pensions. There are challenges. I think that you have to kind of deal with the cards you're dealt with. And I'm very positive. My positive surprise will be that these life cycle funds or target date funds 5 years from now will be the best performance period for pension funds in Chile since they were established in 1980s.
Okay.
Well, thank you, and I invite you. I think we have a coffee break right now. Thank you so much.
Thank you.